Let me begin with a simple truth that most people ignore. The dollar is just paper backed by trust, and that trust is eroding. Throughout history, empires rise and they fall, and so do their currencies. The Dutch guilder, the British pound, and now the US dollar. Most people think collapse means a sudden apocalyptic event, but that's not how this works. It's a slow burn. It's gradual and then sudden. And I've learned from both data and decades of experience that the people who survive and thrive in this kind of transition don't rely on hope. They rely on understanding the cycle and preparing accordingly. So let me share with you what one billionaire knows that most people don't. Throughout history, every dominant currency has eventually lost its status, not because of some external enemy taking it down, but because of internal dynamics, the slow erosion of fiscal discipline, the buildup of unsustainable debt, and the inevitable resort to money printing. People often believe that what they're living through is unique, but when you study the arc of history, you find that the same patterns play out again and again. The tools might look different, the language more modern, but the underlying forces remain consistent. The collapse of a currency doesn't happen overnight. It begins with subtle shifts, rising deficits, growing reliance on credit, and policies aimed at short-term gains rather than long-term sustainability. It's a process driven by political expediency. When a government borrows excessively and can't repay through normal revenues, it turns to the central bank to fill the gap. That creates more currency. And when you increase the supply of something without a corresponding increase in its value, the price of that thing, in this case the currency, goes down. Think of the Roman denarius. Once a strong silver coin, it was debased over time as emperors added more base metals to finance wars and social programs. Eventually, it lost the confidence of the people. The result? Inflation, instability, and a breakdown of trust. The empire didn't fall in a day. It deteriorated gradually, as all empires do when their currencies lose credibility. The same pattern repeated with the Dutch guilder. The Netherlands rose to power on the back of trade, innovation, and strong finances. But as their influence grew, so did their spending. Wars needed to be financed, and debt accumulated. Eventually, the guilder weakened, and with it, the Netherlands' global dominance faded. The baton passed to Britain, whose pound sterling became the next global reserve currency. It too enjoyed a long run of power, backed by the largest empire the world had ever seen. But again, history repeated itself. 2 world wars, massive debts, and a weakened economy led to the pound's decline. In 1944, with the Bretton Woods Agreement, the world transitioned to a new monetary order, one where the US dollar would become the reserve currency backed by gold. And then the settlement that lasted until 1971, when the US severed the dollar's link to gold. Since then, the dollar has been backed by nothing more than trust, and that trust is now under pressure. We're witnessing the later stages of the long-term debt cycle in the United States. Debt levels are at record highs relative to GDP. Interest payments are consuming a growing portion of the budget, and the only politically feasible way to manage that debt is by creating more money, not by raising taxes or cutting spending, both of which are unpopular and difficult to implement at scale. When that happens, when money is created faster than the economy grows, the currency loses value. It's not always visible right away, but it shows up in inflation, in rising asset prices, in the cost of living outpacing wages, and over time, people begin to seek alternatives. That's what we're seeing today. Central banks around the world are reducing their dollar reserves. Trade is increasingly being settled in other currencies. Strategic rivals are developing systems to bypass the dollar entirely. This is not alarmism. It's the natural evolution of an aging system. No reserve currency lasts forever. The average lifespan of a reserve currency throughout history is about 100 years. The dollar has held that title for roughly 80. We are nearing the later innings. If we ignore the lessons of the past, we risk being blindsided by what comes next. But if we study them carefully, we can see the roadmap. The warning signs are always there. They were there for the Romans, they were there for the Dutch, they were there for the British, and now they are here again. The smart investor doesn't just look at today's headlines. He looks at centuries of data. He understands that the rules of the game don't change, just the players. And by recognizing that history is not a line, but a cycle, he can prepare for what others refuse to see. That's how wealth is preserved. That's how stability is maintained, not by wishing things were different, but by accepting what is and acting accordingly. People tend to think in terms of events, one-day crashes, announcements, major turning points. But in reality, the most important shifts in economies and empires don't happen as events. They happen as processes, long, drawn out, often imperceptible changes that unfold over years or decades. The decline of a currency, especially a global reserve currency like the dollar, follows this pattern. It doesn't collapse like a building imploding overnight. It erodes slowly, piece by piece, until one day people wake up and realize that what they thought was money no longer holds the value or power it once did. Right now, we are witnessing such a process. The signs are all around us, but because they're unfolding gradually, they're easy to miss or dismiss. The dollar is still widely used. It still holds tremendous influence in global markets, but underneath the surface, foundational elements are weakening. Confidence is slipping. Alternatives are emerging, and history tells us what happens when these patterns converge. A reserve currency earns its position by being trusted, by serving as a store of value, a medium of exchange, and a unit of account across borders. But that trust isn't permanent. It must be earned and maintained through sound fiscal policy, institutional strength, and relative geopolitical stability. When those pillars weaken, trust begins to decay. The decline isn't immediate. It takes place over a series of small decisions that compound over time: growing budget deficits, political dysfunction, rising debt burdens, and the monetization of that debt. Each time the government spends more than it earns, it must borrow. And each time borrowing becomes too politically difficult or financially unsustainable, it turns to the central bank to make up the difference. That process creates new money, not value, just more claims on the same pool of goods and services. Over time, this devalues the currency, not in a single moment, but continuously as the purchasing power of each dollar shrinks. We've seen this movie before. The decline of the British pound didn't happen in a day. It took decades of war, debt accumulation, inflation, and policy missteps for its dominance to fade. During that time, many believed the pound would rebound. It still functioned, after all. But by the time the world fully shifted to the dollar, the pound's influence had eroded to the point where the change seemed inevitable, even though it wasn't obvious to most at the beginning. The same process is unfolding with the dollar today. For years, the U.S. has run large fiscal deficits, financed increasingly by its own central bank. That's a dangerous trend, not because of one particular policy, but because of the long-term trajectory it creates. When you live in a system where money is created faster than productivity is growing, inflation is not an anomaly, it becomes structural. That inflation erodes the value of savings, distorts investment decisions, and eventually leads global actors to question the reliability of the currency itself. At the same time, the geopolitical landscape is shifting. Strategic rivals and major trading partners are beginning to build alternatives to the dollar-centric financial system. Trade deals are being settled in other currencies. Central banks are quietly diversifying their reserves. These actions aren't loud, they don't dominate headlines, but they are real, and they signal a changing tide. Another misconception is that a declining dollar means it becomes worthless. That's not the case. It means it becomes less dominant. It means its ability to project power and control global capital flows weakens. It means that over time, holding U.S. debt becomes less attractive and the US has to offer more incentives in the form of higher yields, for example, to attract financing. That leads to higher borrowing costs, slower growth, and more pressure to create money. And that's what is going on at the moment. It becomes a self-reinforcing cycle. The people who understand this don't wait for the collapse. They act during the erosion. They diversify, they hedge, they hold real assets that maintain value regardless of the currency used to price them. They avoid the trap of thinking the past guarantees the future. Dominance, once lost, is rarely regained. The key takeaway is this: the decline of a currency, especially one as powerful as the dollar, doesn't happen in one news cycle. It happens step by step, policy by policy, decade by decade. And by the time most people recognize the change, it's already well underway. Understanding this process is not just academic, it's essential for protecting wealth, navigating risk, and thinking strategically about the future. Because while the world may look stable on the surface, beneath it, the currents are shifting. And those who pay attention to the process, not just the events, are the ones who will be prepared when the system eventually resets. Most people base their financial lives on paper promises, currencies, bonds, pensions, savings accounts. These instruments are built on the assumption that they will hold value over time. But the reality is different. When you step back and look at how wealth is created, preserved, and destroyed over long periods, especially during times of monetary stress, you start to see a deeper truth. Real assets hold value, promises do not. And this is something the most successful and financially secure individuals have understood for a long time. The billionaire doesn't view wealth in terms of how many dollars he has. He thinks in terms of purchasing power and how to protect it through cycles of inflation, deflation, monetary debasement, and political uncertainty. He knows that when governments run deficits they can't afford and central banks are forced to step in, they don't create real wealth. They dilute existing claims on it. That dilution shows up as a slow and steady loss of purchasing power in fiat currencies. Over time, it becomes impossible to ignore. Throughout history, whenever fiat currencies were overproduced, their value collapsed. It has happened in ancient Rome, in the Weimar Republic, in Argentina, in Zimbabwe, and it has happened in slower, more managed forms in every major empire's decline. The method is the same: print money to cover unsustainable obligations, devalue the currency, and quietly erode the value of promises. Bonds yield less than inflation. Savings accounts don't keep up with the cost of living. Retirements are destroyed, not with a bang, but with a silent leak. The billionaire avoids that fate because he doesn't hold promises. He holds things that are real, assets that don't rely on someone else's ability to repay or a government's ability to maintain confidence in the money it issues. These assets have intrinsic value. They produce something, they meet needs regardless of what currency is in favor. For example, high quality businesses that generate consistent cash flow and have pricing power. They are real. No matter what happens to the dollar, those businesses still solve problems, sell products, and produce income. Farmland is real. Gold is real. Real estate, especially in locations with enduring demand, is real. These are not speculative plays. They are anchors of value in a shifting world. During periods of currency weakness, these assets don't just survive, they thrive. As the currency declines, the prices of real assets rise in nominal terms, preserving purchasing power. That's not inflation in the traditional sense. That's repricing. The market adjusting to the fact that the money used to measure value is worth less. Those who are holding paper lose. Those who are holding things of substance win. The billionaire also diversifies geographically. He doesn't rely on one government, one currency, or one market. He spreads risk across systems, legal frameworks, and asset classes. This is not paranoia, it's prudence. Usually, the billionaire is born by genius, profit, self, and then scale. This is not paranoia, it's prudence. It's about recognizing that the future is uncertain and positioning accordingly. Another important distinction is the time horizon. Most people are thinking in terms of quarters or election cycles. The billionaire is thinking in terms of decades, generational wealth, not short-term returns. He understands that cycles will shift, regimes will change, but the principles of value endure. Real assets, wisely chosen and properly managed, stand the test of time. In contrast, a promise is only as good as the one making it. When inflation rises and deficits explode, even the most credible governments can back away from promises they've made by changing laws, adjusting benefits, or simply letting inflation do the dirty work. This is not theoretical. It has happened again and again. And in times of crisis, promises are always the first to go. So while the average person chases yield or clings to the illusion of safety in paper, the billionaire focuses on resilience. He asks a different question. If the money system fails to function as it has, what will still have value? That mindset doesn't just protect wealth, it positions him to take advantage of dislocations when others are forced to liquidate. Owning real assets isn't about fear, it's about clarity. It's about looking beyond the noise and understanding how the economic machine actually works. Because in the end, the financial system is just a layer. Strip it away, and what matters are the things that feed people, house people, power the world, and solve real problems. Those are the assets worth owning. Those are the assets that endure. Most people think of debt and money printing as separate economic tools, one involving borrowing and the other involving the central bank creating currency. But when you zoom out and understand how the economic machine works over long cycles, it becomes clear. Debt and money printing are just different expressions of the same underlying force. They are two sides of the same coin, both designed to do one thing: fund spending that exceeds income. And over time, when used excessively, they lead to the same destination, a decline in the real value of money. When a government spends more than it brings in through taxes, it needs to bridge that gap. Initially, it borrows from investors by issuing bonds. That seems sustainable for a while, especially when interest rates are low and confidence in the system is high. But the deeper a country goes into debt, the more fragile that system becomes. Debt needs to be rolled over, interest payments grow. Eventually, lenders demand higher compensation for the increasing risk. And that's where the tipping point begins. Because once the debt burden becomes too large, the only politically viable option left is for the central bank to step in and buy that debt, effectively creating new money. This isn't just theoretical. It's how most modern monetary systems have evolved. When private investors stop buying enough government bonds at acceptable rates, the central bank becomes the buyer of last resort. That's money printing. It's not done with printing presses anymore. It's done digitally by crediting bank reserves and purchasing securities, but the result is the same: an increase in the supply of money without a corresponding increase in productivity or real output. And here's the key point. Debt-financed spending becomes money-financed spending when central banks are involved. That's the transition from phase one to phase two of the debt cycle. In phase one, debt fuels growth. In phase two, money creation tries to prevent the collapse, but it comes at a cost. The more money that's created, the less valuable each unit becomes. Not immediately and not evenly, but inevitably. This dynamic creates a hidden tax: inflation. It erodes the real value of money, savings, wages, and bonds. And yet, it's politically easier than raising taxes or cutting spending. That's why it's used. That's why every heavily indebted country eventually goes down this path. It's not about ideology, it's about math. When the interest on the debt consumes too much of the budget, policymakers look for relief, and the central bank provides it. People don't feel this process right away because it happens slowly and because its early effects can look positive. Rising asset prices, more liquidity, lower interest rates. But over time, the side effects grow. The cost of living outpaces income, wealth gaps widen, and confidence in the currency begins to fade. In extreme cases, it leads to hyperinflation. But in most cases, it plays out as a long, grinding decline in purchasing power. The dollars people save today buy less tomorrow. The promises made through bonds and pensions become worth less in real terms. That's the real consequence of combining excessive debt with money printing. It doesn't eliminate the debt burden. It shifts it onto the public through currency devaluation. That's why when analyzing any economy, it's critical to look at the relationship between its debt and its central bank. When governments and central banks operate independently, monetary policy can remain disciplined. But once they become intertwined, when the central bank is effectively financing government deficits, that's a signal that the system is moving into a more dangerous phase of the cycle. This doesn't mean collapse is imminent. Systems can run on momentum for a long time, but it does mean that the foundation is weakening. And when the underlying trust in a currency declines, everything priced in that currency becomes unstable, from wages and savings to trade agreements and geopolitical alliances. The important takeaway is that debt and money printing aren't isolated policies. They're part of the same continuum. When a government can no longer borrow affordably, it leans on the central bank. That's when the illusion of independence breaks. That's when the monetary system starts to shift. And that's when investors need to be most alert, not to the headlines, but to the underlying mechanics. Because once you understand that debt and money printing are two ways of funding the same excess, you begin to see the risks, not just in economic terms, but in terms of trust. And once trust in money begins to erode, history shows there are only a few ways it can end. Survival in a changing financial world isn't about making perfect predictions. It's about building the resilience to withstand what you can't predict. The truth is, no one knows exactly what's coming next. There are always too many variables: geopolitical events, policy responses, human behavior, technological shifts. But over time, what separates those who thrive from those who fall behind is not their ability to forecast the future. It's their ability to stay balanced, diversified, and adaptable through uncertainty. The economic environment we're living in is increasingly unstable. Debt levels are historically high, geopolitical tensions are escalating, the long-standing rules of globalization, monetary policy, and trade are being rewritten. In such conditions, relying on static strategies, putting all your chips on one outcome, one region, one asset class, is risky. In fact, it's the opposite of how systems survive long-term. Nature provides the best analogy. Species that thrive in unpredictable environments do so because they evolve, adapt, and diversify. The same logic applies to wealth. A portfolio that is overly concentrated, whether in a single currency, economy, or type of asset, becomes vulnerable to regime shifts. But a portfolio that is thoughtfully diversified, that incorporates both offensive and defensive assets, and that is adjusted as conditions change, is far more likely to survive and grow across cycles. Balance means not being dependent on any one outcome. It means having exposure to assets that perform well in different environments: inflationary, deflationary, growth, contraction, because history teaches us that markets don't move in straight lines. They shift in phases, and the strategies that worked in one phase usually stop working in the next. The key is not to fall in love with any one position or belief. The key is to maintain equilibrium. Adaptability is just as important. Markets evolve, systems change, and new risks emerge. Being able to observe these changes with clarity, free from emotional bias, and to adjust your strategy accordingly is essential. That requires humility, the willingness to accept when you're wrong, and discipline. The ability to act despite uncertainty. Most people struggle with this. They either double down on losing positions, believing the world will revert to what they're used to, or they panic and make erratic decisions at the worst possible time. Neither is sustainable. Those who succeed over long periods build systems that can adapt automatically. They stress test their assumptions. They simulate different scenarios, inflation spikes, currency declines, market crashes, wars, and assess how their portfolios would perform under each. They don't pretend to know what's coming. They prepare to survive regardless of what comes. It also means recognizing when the environment itself is shifting. Today, we're seeing the early stages of a transition from a unipolar world led by one dominant power to a multipolar one, where influence is divided among competing nations. That brings with it new risks, fragmentation of trade systems, financial decoupling, and conflicts over currency and technology standards. Navigating this requires more than just financial insight. It requires geopolitical understanding and a global perspective. The same applies to the domestic front. As wealth gaps widen and political polarization deepens, the risk of internal conflict rises. That's not just a social issue. It's an investment issue. It affects tax policy, regulation, productivity, and even the legitimacy of institutions. So survival also requires thinking beyond spreadsheets. It means understanding the broader forces shaping the world and being prepared to respond to them. Another key element is psychological flexibility. In periods of rapid change, fear and greed dominate most people's behavior. They chase trends when they should be cautious. They retreat in panic when they should be patient. The best investors cultivate emotional discipline. They stay grounded in principles, not emotions. They recognize when markets are irrational and they avoid getting swept up in the crowd. That allows them to act rationally when others cannot. In the end, survival isn't about certainty. It's about robustness. It's about building a position that can withstand shocks and capitalize on opportunities. And it's about constantly updating your understanding of the world, because the world is always changing. Those who cling to the past, to what used to work, will be left behind. But those who build balance into their portfolios and adaptability into their thinking will find themselves not only surviving, but positioned to benefit when the next shift arrives. That's how you navigate uncertainty. That's how you preserve wealth. And that's how you stay ahead of change instead of being consumed by it. Now, the billionaire doesn't panic. He doesn't bet on collapse. He simply studies the patterns and he positions himself accordingly. Because in times like these, survival isn't about being the smartest. It's about being the most prepared. You don't need to be a billionaire to do what the billionaire does, but you do need to think like one. So ask yourself, are you holding promises or are you holding value? Because when the dollar stumbles, and it will, only those who've positioned themselves wisely will stand strong. This isn't about fear. It's about clarity. It's about understanding how the world really works before the world teaches it to you the hard way.